So moving on, question C of this question. Can you all hear me? Hello, someone should confirm. Can you hear me?
Yes, I can.
Okay, thanks. So calculate a project-specific cost of equity for project B, and then explain the stages of your calculation. 6 marks. So to earn these marks, you need to also be able to explain the stages of your calculation. So let's look at project B. This project is a diversification into a new business area that will cost $4 million. So a company that already operates in the new business area is called GZCO, and this company has an equity beta of 1.5. This company is financed 75% by equity with a market value of $90 million and 25% by debt with a market value of $30 million. Remember, I told you anytime there's change in risk, you need a proxy company. That is, even if it's a change in business risks, for instance, you need a proxy company. And we have been given the proxy company. And that company is GZCO. And we also have been given all the necessary things we will need, which is the capital structure, 75% equity, 25% debt. We're also even given their values in dollars. Okay, $90 million equity, $30 million debt. And we're also provided with the equity beta of this company, 1.5. So which means with this information, we can then run through on gearing process, because that's the first thing that needs to be done. For this CJCO to adopt the business risks in the new business area using this proxy company, we need to ungear the equity beta of this GZCO, which is the proxy company. So we are explaining the stages of our calculation. First, let's state out the data. GZCO. The equity beta is 1.5. Equity value is 90 million. Debt value is 30 million. And we are given also their proportion. If you want to work by proportion, we are told this is 70%, 75%, and this is 25%. And truly, if you do their percentage, you will see that it's true. So this examiner is so nice. We are told that this project is going into will cost $4 million. Okay, it's good to note, but do we use cost in performing on gearing and regearing? The answer is no. So that information is good. It's nice to have, but it's not applicable to our calculation. Now, on gearing is the first stage. So the stage 1 is to do what? On gear GZCO's equity beta. Okay, that's the first thing. So to ungear, what we want to do is we want to remove the financial, you have to explain, remove the financial risk of what? GZCO. To determine its what? Business risk. And that business risk is what? Asset. We're explaining. Okay? Now, to do that, we need to say our BA equals BE. You don't need to write this formula, but I'm just writing it because some of us needs to get used to it. BE, isn't it? BE divided by, am I correct?
Yes, sir.
Bracket with BE
BE
plus after tax.
cost of BD.
Hello, who is that? So this is the formula we're applying. So are we ready?
Yes, sir.
Oh, that sound is coming from.
Oh, apologies. Is it too loud? I can go on mute. Sorry.
Yeah, please mute. So BA equals what? So let's apply it. BA equals, this is the BE, isn't it? Multiply by VD. So you could use percentage, you could use value, no problem. So 90 million divided by bracket open, 90 million plus 30 million times 1 minus tax. Do we have tax rate here? Yes, we are given
30%.
30%. So I'm going to take it. I'm going to use it. Don't worry. So let me just for now put it there. The bracket close. So let me state the tax rate here. 30%. So that I don't add code. Then pick it directly. Okay. You see that I didn't add code. So 1.216. Please confirm. Is that what you have?
Yes, sir.
Yes.
Okay. So that's the first stage. What's the next stage?
Regear it using CJCO's debt and equity.
Regear. How are we regearing? GZ calls asset beta, isn't it? What? Capitals of what? Isn't it? CJCO. So what are the capitals of CJCO? What are the capitals of CJCO? Equity
Is
value is 180 million.
And debt is
Yes.
45 million.
And then this is 45 million, isn't it? Okay. So let's now regear. Now that we are looking for, which I'll call regeared BE in this case. Regeared BE equals what? BA times bracket open BE plus VD times 1 minus tax, bracket close, everything divided by VE. Okay, that's what we're applying now. So which will be equal to what? 1.216 multiplied by bracket open value of equity of CJCO plus after tax value of debt of CJCO, so 45 million times 1 minus tax. This tax rate of 30% is applicable to both companies. Bracket close, all bracket close, divide by value of equity. 1.429. Confirm?
Yes, sir.
Okay. So then what is the last stage? Apply CAPM, isn't it?
Yes, to get project specific cost of
So apply regeared BE into CAPM formula. That's the third stage. So remember that where we are gearing here, we can also state what we are doing to explain it. So let's state it. What are we doing here? We are incorporating, isn't it? Incorporating CJCO's financial risk into what? The beta. So our stage 3, we now apply regeared B into CAPM formula. Remember our CAPM formula. KE equals what?
Risk-free rate plus beta into premium.
Plus
Beta.
Okay.
Beta times risk premium.
Equity risk premium, ERP, isn't it?
Yes, sir.
And that is RM minus RF. So that's what we are doing now. So equals to, let's state out all we need. So what's our risk-free rate?
4%.
What's the market return? Are we given?
No, we're
Okay, we are
giving the
ERP.
premium.
Okay. Equity
premium.
risk premium. ERP. 6%. So with this, we can say KE equals 4% plus 1.429 times 6%. So 12.57, thereabout. Any question?
If the question doesn't ask us to put it in any decimal place or anything, what
No, don't even bother yourself with putting in whatever you have calculated. Leave it the way it appears. Move on, because you don't have to waste your time on taking it to decimal. Since the question is not saying take it to 2 decimal or 3 decimal. Do you get? I only did this just because of the view, so that you'll be able to see the view. Okay.
Yes, sir. Thank you.
So this is our project. Project specific. If there's no question, so we'll move on. Tufako is the next question. So this is about business finance. We are required to calculate the after-tax weighted average cost of capital of Tufako on a market value basis. Then B says, discuss the circumstances under which it is appropriate to use current work of Tufacco in appraising an investment project. And the last part is saying discuss 3 advantages to Tufacco of using convertible loan notes as a source of long-term finance. So on this page, we'll be dealing with A part. The following statement of financial position information relates to Tufacco, a company listed on a large stock market which pays corporation tax at a rate of 30%. So let's quickly note that. Now, so we have the information given to us in the book. So for equity, so we have the nominal value. In total value, we have how much? 17 million. So the question says we should calculate after tax work on a market value basis. So once you see such, ignore reserves and move on. Retain earnings, ignore it and move on. So just take note of the share capital, 17 million, isn't it? So let's move on. We have information about non-current liabilities. We have information about current liability. We don't need that. So just the long-term borrowings of 13 million we need. So let's look at additional information on equity as it relates to equity. The share capital of Tufacco consists of 12 million of ordinary shares. Can we see it? 12 million of ordinary shares. So which means this nominal value we are talking about. So we have that of ordinary shares. And 12 million. And we have also preference shares. 5 million of irredeemable preference shares. That's how 7 million has been derived. So our focus is that we are given these 2 items. Please take note. The ordinary shares of Tufacco have a nominal value of 50 cents per share. So ordinary share value 0.5. So which means quickly you can use this to get number of ordinary shares, isn't it? Hello?
Yes, sir. Yes, sir.
So you can just start doing your calculation immediately and be earning your mark. Number of ordinary shares will be ordinary shares nominal value in total divided by par value. So 24 million shares in issue. And we are told that X dividend market price is 7.07 per share. So X div market price 7.07, which means we can use this to calculate total market value. You agree with me? Because you know you need
yes, sir.
total market value in $1 million. And that will be equal to 7.07 multiplying 24. Exactly. So we have 170 million for equity. Okay. Now, moving on. We are told a cum div market price of 7.52 per share. So there's a cum div. What's the implication of that?
It includes dividend. You have to remove false dividend.
7.52. So do we need it? Do we need it?
No.
You mean no?
To get
Okay, let's
dividend.
note it. Let's see whether we need it or not. Let's move on. The dividend for 20X7 will be paid in the near future. So dividend paid in recent years have been as follows. Okay, from 20X3 to 20X6. So this financial given to us is for what year?
20x6.
20x6.
Oh, this one is for 20x7. I mean,
20x7, I think.
this financials we've been given is 20x7.
Yes,
Do we all
20x.
agree?
Yes, sir.
Okay, so let's do something to consolidate on the top. So dividend
Get our
that will be
dividend.
paid in near future is what?
Cum div minus x.
Cum div minus x div.
What do we have? 45, isn't it?
45 cents.
Yes, sir.
Okay, so which means it's not a 20x6 dividend. You agree with me?
Yes, sir.
So that consolidates the thought to say the information is for 20x7.
X7, yes.
Okay, that's fine. Okay, so we are given history of dividend. So which other dividend do we need?
The base dividend.
Base. Okay. So, and if the base dividend is, what is it?
0.37.
0.37. Okay. So what do we intend to do with that?
To calculate growth.
To calculate growth. Okay. So to calculate growth, what do we now do? Formula.
Just dividend divided by base dividend. All
So we are
power
saying this
n
is
minus
to be
1.
current.
N minus 1.
So growth in dividend by G equals bracket open, current dividend divided by base dividend, bracket close, to the power of what? 1 over what?
1 over 4.
Do you all agree?
Yes, sir.
Okay.
Yes.
Everything minus 1. So this is what I have. Is that what you have?
Yes, sir.
Okay. So if that's our G, what do we want to do with the G?
To calculate cost of equity.
Exactly, because we are to calculate WACC. We need cost of equity. We need total value of market value of equity. We've gotten the total market value of equity. We now need cost of equity. That's why we have calculated G. So using dividend growth model, so our KE will be equal to what?
Dividends into 1 plus growth divided
Current
by
dividend
current
multiplied
dividend
by 1 plus growth, isn't it?
1 plus growth
Yes.
Divided by
x div market price.
which of them?
7.07
0.07.
Okay.
plus 5% plus growth.
Everything plus growth. Okay. We all agree?
Yes, sir.
So about 11.7%. So can someone contest that maybe we don't need to grow the dividend? Is someone saying that? Or do you all agree we need to grow it?
We need to grow it. Right?
So can you interpret this statement and tell me? Dividend for 20x7.
We're giving our expected dividend.
We're even told the year. Dividend for 20x7 will be paid in the near future. Can someone tell me what that means?
That's expected. Expected
That's it has not been paid.
It has not been
So I'm asking
paid.
that, is that DO or D1?
D1, it's D1.
Is it D1?
It's D1.
Okay, this my question is valid. So just for you to know that this is DO, is not D1, and what we have done is correct. So the reason is that don't be tempted by the word near future. Okay, the question is what this dividend is for what year? It's for current year of 20x7. So it remains DO. The only thing about that near future is that it's consolidating on that statement that says there's a cum div market price. So which means that when you have a cum div market price, it shows to you that that price is inclusive of dividend. That's why we have to back out our XDiv market price from it to know what that dividend is actually is. Okay, so it's just consolidating on that statement. Okay, so please take note. So our cost of equity is 11.7, so we've dealt with equity. So the other source of finance here is preference shares, we are told here. So for preference shares, let's look for the details about preference shares. Do we have any details? Let's find out. Yeah, so I can see 5% preference shares. So preference shares. Fixed dividend. 5% preference shares of Tufaco have a nominal value of 50 cents per share. So that 5% represents the fixed dividend rate, isn't it?
Yes, sir.
And that will be paid based on the investment value. Each investment worth 50 cents per share. Okay, so nominal value per share is 50 cents, which means dividend payable is how much? 5% of these 50 cents. Can we see it?
Yes, sir.
X dividend market price of 31 cents per share. X div market price 31 cents. With this information, we can calculate cost, isn't it? Cost of preference shares.
Yes, sir. Cost of preference shares.
AP equals dividend payable divided by X dividend. Okay, so this is about 8.1%. And then we can also calculate total market value of preference shares. As we need the number of preference shares. Do you agree with me? Number of preference shares. To get number of preference shares, we will divide the nominal value in the book, which we have here, 5 million watts, by the par value, which is 50 cents. So we have 10 million preference shares. And then we can get total market value of preference shares by multiplying 10 million by 31. Okay. So we've gotten cost, we've gotten market value. The other source of finance Okay, your question.
Can you go over the formula for KP and number of preference shares?
So KP, which is the cost of preference shares, equals to dividend payable in amount, which is 2.5 cents. Are you with me now? Divided
Yes.
by the XD market price of a preference share, which is 31 cents. That's the formula for it. Okay, that's how we got this. Then for the number of preference shares, we say how much is preference shares in the book in total? 5 million, we're told. And then divide that by a unit price. A unit price in the book is 50 cents. That gives us the number of preference shares. Did you see that?
Yes, sir.
Okay,
So
good.
the total market value is
So total market value
XD.
now number of preference shares times 1 unit of share in the market. How much is it? 31 cents. Okay. So multiply both and we got $3.1 million.
Okay, sir. So what is KP?
KP is the cost of preference shares.
Okay.
Okay. So moving on. That source of finance we can see here, it's about the long-term borrowing. The long-term borrowings of Tufaco consist of $10 million of loan notes and $3 million bank loan. The bank loan has a variable interest rate. The 7% loan notes have a nominal value of $100 per loan note and a market price of $102.34 per loan note. Annual interest has just been paid and the loan notes are redeemable in 4 years' time at a 5% premium to nominal value. Let's look at the splits. The long-term borrowing consists of two things: loan notes and bank loans. So let's take them one after the other. For loan notes, in the book, so nominal value $1 million is 10. And we are told that is a 7% loan note, which means the annual interest rate 7%. And we are told it has a nominal value of $100 per loan note. So nominal value per note is $100, on which we can compute annual interest in dollar. That will be equals to 7% of $100. That's $7 million. We are also told that it's a market price of 102.34. So, and we are told that the annual interest on it has just been paid. So when you hear has just been paid, the implication is that that market price per loan note given to us is an ex-interest market price. If it is that the interest will be paid in the near future, then we can say that that market price given to us is a cum interest market price. Please take note of that. But we are told that the annual interest has just been paid. So it means the market price given to us is an X interest market price, which is what we need. Okay? I hope you are taking note of that. X interest market price is what is given to us, even though it's not expressly stated. It is that statement of interest has just been paid that explains that. So 102.34. So noted. And we are told the loan notes are redeemable in 4 years' time. So redemption period is 4. And then what's the redemption value? We are told it's going to be 5%, isn't it? Are we following?
Yes.
Nobody is responding.
Yes, we are.
Following, sir. Following, sir.
So having got this, the next thing is then to use these cash flows we have, discount them at two different discount rates to get what is likely to be the cost of this instrument, which is the IRR formula. We ready? So
Yes,
like I
sir.
thought the last time, we have two ways. Can use the IRR formula by spreadsheet, or we use the interpolation. So what are we using?
IRR, sir. IRR.
Forward.
Straight to the answer.
So let's list them. 0, 1, 2, 3, 4. Okay. Here 0, what's the value? Negative.
100.
No.
Mm.
No.
Okay.
Market value.
Market value.
Okay. Year 1.
Year 1.
7.
7 times the interest rate.
So we got it at 7.
Tax rate, rather. Times tax rate.
Yes, we got it at okay, times tax. Okay, 1 minus t. That's what you're saying. Okay. 4.9. And that will happen throughout up to year 4. But in year 4, what comes in additionally? Redemption, isn't it?
Redemption value.
So we add that to it. And once we have this, never you separate these two, always add them, because if you separate them, IR formula will see it as 5 years. Okay, it's actually 4 years. Which will say cost of loan note equals to IRR bracket, all of these, isn't it? Confirm your result. Is that what you have?
Sir, please can you place the cursor on the 109.9?
Okay.
Redemption value plus what?
Sorry, say that again.
Then, sir, please can. Oh, sorry.
Okay, okay.
Okay, then,
Okay.
sir, please can you place the cursor on the 105?
Are you comfortable with that?
Yes, sir. And
Okay.
then, sorry, then one more thing. Please, can you place the cursor on the second 4.9?
4.9. Okay, how we did this? Okay.
No, the second one. I actually got that first one.
Okay, so we just equate it to this. Since it's going to be the same amount. Equals to that.
Sir, please place your cursor on the IRR.
IRR.
Yes, sir. Oh, okay. Thank you, sir.
Okay. Any other question? So we can move
No,
on.
sir. Go on.
So bank loan. Nominal value is how much? We are told is it's 3 million. It's 3 million. So out of the 13 million, bank loan is 3 million, loan note 10 million. So nominal value in million of dollars is 3. Okay. Oh, before that, have we calculated the market value of loan notes? We haven't. Can we do that quickly? So we have the X interest market price of 102.34 for loan notes. So how many loan notes is an issue? Do we have an issue?
10,000.
How did you arrive at that?
100,000. 100,000. 10 million
Number
divided
of
by
loan
100.
notes equals to total nominal value of 10 million divided by nominal value per loan note. So that gives us $100,000, isn't it?
You will not carry that thing like that because it's
No. It's in millions, I know. So that's 100,000. It's understandable. Okay. So then we can calculate the total market value in million dollars, which is equal to 102.34 times number of loan notes. So we have 10.23. Question on this?
Okay, sir, please can you put the cursor on the 10.23?
Is that fine by you?
Yes, thank you, sir.
Okay. So for bank loan, so we are told nominal value is $3 million. And then the next thing is since bank loan is not tradable. So what happens? So we assume this is also the market value.
Okay.
So if anytime you feel like you want to sell the loan note, the bank loan, you sell the outstanding balance. Is that not so? And that's what will be the market value. So 3 million what? Now the next thing is, what then is the cost of this instrument? What do you say about it? Bank loan has a variable interest rate. So this is similar to the question someone posted on the group yesterday. So what's our response to this?
5.3 now.
Thank you. That means you were with us yesterday. So we're going to take it. We'll take the cost of the loan note as the reasonable assumption to be the cost of a bank loan. Okay. So having got all the values we have, then we can calculate WACC. Equity, preference shares, loan notes, bank loan, cost of the instruments, market value of the instrument, the weight of value, and then the weighted cost. So weight of value is going to be market value of that instrument divided by the total. Total will be here. Next one, market value divided by the total. Next one, it's market value divided by the total value. Next one, the market value of that divided by total value. And then weighted cost is going to be whatever the cost of that instrument is multiplied by the weight of that instrument. We do other same way.
Sir, you are too fast.
Sorry.
Hello, sir. I don't understand how we got the 5.39 for the cost of bank loan.
Cost of bank loan. So we are taking the cost of the loan note as the average cost of bank loan.
Why is that, sir, please?
So that is the reasonable assumption we can take with this question. That's the only thing that can be applicable in this scenario. So we are told that the bank loan has what? Bank loan has a variable interest rate. So which means it changes. So it's not fixed. Is that not so? Are you following?
Yes, sir.
So it's not fixed. So it changes. So it moves from one point to the other. So the only thing that is reasonable.
Hello. Is this my network or did I just lose MBA?
It's not your
I
network.
think
It's every-
Okay.
Hello, can you all hear me?
Yes, you are back.
Yeah.
Oh, okay.
You went muted.
Someone muted me, or no. Someone muted me, or what? Okay. So what did you hear from me?
You are explaining the variability of bank loan.
Yeah. So I said the interest rates, we are told that it has a variable interest rate. Okay. So it changes. It's not a fixed interest rate. Don't forget that if you want to calculate cost of bank loan, it is the interest rate we can use, as the cost of the instrument. Okay. Now, so which means that the interest rate is not fixed, it is variable. So what it's obtainable in the market is what we are going to use as reasonable cost of that instrument. The only instrument in that bucket, okay, of a long-term instrument, long-term debt, is loan notes, okay? So, and that's the only one we can use as a benchmark, to take a reasonable assumption. So whatever the cost of that instrument is what we can use for bank loan in this case. Did you get that?
Yes, sir.
Yeah.
So, sir, can there be any question that it's the only one that we can use will not be bank loan notes? Is it possible?
So in the category of long-term borrowings, okay, what other instrument do you think you will be given if it's not loan notes? The only thing you can be given is preference shares.
Yes.
Under non-current liabilities, isn't it?
Yes.
But they are not of the same feature. Do you understand? Preference shares is not of the same feature with loan notes and bank loan. It's only those two categories that are in the same feature. Do you understand?
Yes.
So that's why we can use that.
Thank you.
Can't use that of preference shares. You get?
Yes, sir. Thank you.
All right. So equity, cost of equity we calculated. So let's put them in the table so that the formula can respond. So this is it. For preference shares, we calculated this is it. For loan notes, 5.9. Same for bank loan. And the market value for equity, 169.68. For preference shares, 3.1. For loan notes, 10.23. For bank loan, 3 million. So at the end of the day, our work is the sum of all the weighted costs. That's our work. Any question?
Sorry, check if this 5.39 should be changed to 0.0539.
Which one is that? This one?
No, when you bring it down to the table.
Okay. So I understand what you are saying. It doesn't matter. Okay, it doesn't matter. Don't just give yourself, because these guys also should be in percentage. It's not a problem because this appears in percentage. So it's showing the same way here. So this one too, this equity and preferences, they are costs. We can put them in percentages. You get?
Okay, they are the same. They are plain
It's the
as
same thing. It's not a problem. Okay. So if you want to convert these to decimal now, I can pay special on this guy. Can you see it? Can you see it? Hello?
yes.
Okay.
Hi.
It's not,
No,
but it's not
sir.
a problem.
Hi.
Okay. So this is our work. It has to calculate. And we are done with that, just to calculate 11 months. Any question before we proceed to B and C?
Yes, sir. Please, can you go over the formula for the weighted value and weighted cost?
Weighted value is this. Look at for equity. For equity is the market value of equity divided by total market value of the company. Total market value of the company is the sum of all the market values of the instruments. You get? Hello?
Yes, sir.
So for the next instrument, preference shares, take the value of preference shares divided by the total market value of the company. And you do same to this. Can you see it? Do same to this. So from here, you get all the weights, all their individual weights. So the individual weight multiplied by individual cost, you get weighted cost. For each of them, then you sum all the weighted costs to get WACC. Are you cool with that?
Yes, sir.
Okay. All right, so moving on. TUFACO B and C. The first question says we should discuss the circumstances under which it is appropriate to use the current work of TUFACO in appraising an investment project. So what are those circumstances? I've shared this with you. So the current work of the company means what? The average return required by the company investors. This is the average return they are expecting based on the current levels of the business risk and financial risk of that company. So this is the average return they are expecting. If risks should change, if risk is increasing, that expectation will change. Okay, so that's why we need to now discuss the circumstances under which this current work will continue to be their expectation. This current work can be used to appraise a new project, provided that new project is not bringing about a change in business risk. It can also still be used to appraise a new project, provided that project is not bringing about a change in financial risk. These two risks can change concurrently. These two risks, either of these two risks can change. So it could be business risk that is changing, while financial risk is not changing. Let me take you back to the question on CJCO. Okay, when you are going into a new business area, it implies that business risk is changing. But of course, they will do the funding with their available capital, which means capital structure is not changing, and that means financial risk remains same if capital structure is not changing. So it means only business risk changes in that scenario. And what did we do? We'll ungear with a proxy company data, and we then incorporate the capital structure, which is the financial risk of CJCO. So it is also possible CJCO, let's say, is embarking on a new project, but that new project is in the same line of their business, which means business risk is not changing. But it could be that that new project requires special funding, which is going to alter their capital structure. If that happens, it means the financial risk of the company is changing, but business risk is not changing. Did you all hear what I've said? This is a very valid point I'm painting here. Did you hear what I've just said?
Yes, we did, but
Yes, sir.
Okay. So when that happens, you will not need proxy company When that happens, you will not need proxy company because the company is embarking on a project in the same line of business, but it's just that that business, that new project requires special funding that will alter the capital structure, which will make the financial risk to change. You will not need the words proxy company. What you will need is just to ungear the current equity beta of their company, removing their current financial risk. Okay, so the same formula of ungearing, but every data you are using will be that of the current of the company that is investing. Okay, you will remove their financial risk. You will be left with their asset beta. You will now regear the asset beta with the new capital structure. So the new capital structure could be that in the case of CJCO that they say 75, 25%, maybe the new capital structure is now 80-20. So you now use the new capital structure to regear their asset beta. That is where there's a change in only financial risk. Okay, so I'm just trying to let you know how to treat situation like that, but that's not what we are going to write here. What we are writing here is that circumstances under which it's appropriate to continue to appraise project with the current work of TUFACO is when the business risk is not changing and also financial risk is not changing. At the same time, the project that company wants to embark on is smaller in size compared to the company itself. Okay, when that is the situation, then the current work can be used to appraise that project. Okay, so when the company is embarking on the same line of business, it means the current equity beta remains same. It's not altered. Just like I've told you before, it's not altered. So asset beta remains same. Equity beta remains same. Nothing is changing. Okay. Any question? Any question on this?
No, sir.
Okay. Now, the C part of the question says, discuss 3 advantages to TUFACO of using convertible loan note as a source of long-term finance. So what makes convertible loan note a good one? First is that there is a benefit accruing to the company at conversion rather than redemption. So what is that benefit? So TUFACO will use cash for something more strategic once the investors are fine with the conversion. So guess what? If they are redeeming, TUFACO will have to cover out cash because it has to pay them. But once they decide to convert, TUFACO just need to issue shares to them. So he will not part away with cash. So he could use that cash for something more strategic in that business. Another reason is that this instrument comes with lower interest rates. So can someone tell me why it's coming with lower interest rates?
Because the risk is lower than ordinary shareholders.
Sorry?
The risk involved in ordinary shareholders is less than the one for present shareholders.
The risk is lower, is that what you're saying?
Yes, for preference shares, it's lower than ordinary shares.
Okay, so you can imagine the risk is lower because there's an attribute here or a feature that it can be converted to equity. So it's a lot secured in a way. Okay, so but you know, the thing is that it's coming with that benefit. So also, so the interest charge on it is lower. But guess what? It will attract higher return because of that feature of equity. So what they will say is that they will accept it as an investor. So they accept it. And when they accept it, what happens? It then means that the company is paying a lower interest rate in the profitability position, they record lower finance cost. So it helps them to boost their profit level. Is that not so? Hello? Did you hear that?
Yes, sir.
Okay. So that helps to improve the profitability of the company. The other bit is that it helps increase the debt capacity in future. So the moment the investors convert, so that portion of the debt moves to equity. When it moves to equity, what happens? The gearing comes down. Gearing level comes down. Financial risk comes down. Because once the gearing comes down, the financial risk comes down. But guess what? It creates a vacuum. That vacuum is opportunity for the company to access debt in future, so they can have room for space. I mean, a space which, you know, a space for additional debt in their capital structure. Okay, that's what it means, to increase the debt capacity in future. The last one here is that there is an avenue to attract investors here. Ordinarily, if you call on investors, equity or public, to buy your shares, they may feel reluctant to buy your shares. But if you use convertible loan note to call on investors, it gives them a kind of benefit, okay, that they can become co-owner in future if it makes sense to them in future. So you can use that to attract public to, invest in your company through debt and then become part owners in future time. So you attract investors to become owners in the future. Any question? Any question? Hello?
No question, sir.
All right. So there's no question. Let's move on. Datiko is the next question. Datiko. So this also on business finance and valuation. So we have to calculate the theoretical extract price per share prior to investing in the proposed business expansion. Just 3 marks for you. So you don't need to waste time here. BPAS says calculate the expected share price following the proposed business expansion using the price earnings ratio method. So this is about valuation. The CPAS says discuss whether the proposed business expansion is an acceptable use of the finance raised by the right issue and evaluate the expected effect on the wealth of the shareholders of Datiko.
This one is not working again.
Hello? DPAT says, using the information provided, calculate the ex-div share price predicted by the dividend growth model and discuss briefly why this share price differs from the current market price of Datiko. And when you are done, the EPAT says you should explain the nature of the agency problem and discuss the use of share option schemes as a way of reducing the agency problem in a stock market listed company such as Datiko. So on this page, we'll be dealing with question A to D. So let's start. What's the scenario all about? Datiko is a stock market listed company that manufactures consumer products and is planning to expand its existing business. The investment cost of $5 million will be met by a 1-for-4 right issue. So they want to raise $5 million worth. But how they want to do is 1 new share for every 4 existing shares. The current share price of Datiko is $2.50 per share. And the right issue price will be at a 20% discount to this current share price. The finance director of Datico expects that the expansion of existing business would allow the average growth rate of earnings per share over the last 4 years to be maintained into the foreseeable future. So the earnings per share and dividend paid by Datico over the last 4 years are as follows. So Datico has a cost of equity of 10%. The price earnings ratio of Datico has been approximately constant in recent years. We are asked to ignore issue costs. So let's start. Amount to raise is $5 million. And this has to go by a 1-for-4, okay? So let's do what's our current number of shares. And then what's the new, which is the right. So for every 4, you get 1 new one. That's what we are told. And then what is the price? Current share price is 2.5. And we are told that the rights will be sold at a discount of 20%. So which means rights issue will be 2.5 multiplied by 1 minus discount. Do we agree?
Yes, sir.
So what then is the value? For the current one, the existing shares, is a worth of 4 units times 2.5, which is $10 for 4 shares. Okay. Then for 1 right offer is 1 times $2. So the question is, how many shares would you now have? So it will roll out to be 5 shares. If you have 1 new for every 4, it means you have 5. Okay. And that would translate to a total of $12. So theoretical ex-strike price will be equals to $12 divided by 5 units of shares, and that will be 2.4. Do we agree? Are we comfortable with this?
Yes.
Yes.
Okay.
Yes, sir.
So as simple as that, that's why it's 3 marks. Okay. So if you want to work in dollar value, you can use the amount they want to raise to get the number of additional shares that they will have, and then get existing shares and all of that. But why do you want to waste your time doing all of that? Why don't you just move on and see this 5 million as a nice to have? Okay. The BPA. We have to calculate the expected share price following the proposed business expansion.
Please, can you show how the 2.4 is gotten? The 2.4.
Sorry?
Can you show how the 2.4 is gotten?
2.4.
Yes. Okay.
Have you seen it?
Yes, I have.
Okay.
Please, can you also show how you got the 2 for the new rights offer?
This one, our value, which one?
The share price, please.
Share price. 2.5 times 1 minus discount. Discount is 20%.
Okay.
Have you seen that?
Yes, please. Thank you.
Good. So moving on. So we are told that we should calculate the share price. The expected share price following the proposed business expansion using price earnings ratio. So what comes to your mind? Hello, I'm listening. No, what comes to your mind? I need someone to talk.
We lost you at a particular while. I wasn't hearing you at a particular.
Yes, sir. Please.
Oh, I asked, I said, what comes to your mind? We are asked to calculate the expected share price following the proposed business expansion using PE ratio method. What comes to your mind?
Maybe earnings divided by. Well, we don't have earnings.
So
you don't have
it's
earnings.
just, I think, just for us to do PE ratio multiplied by the EPS.
Okay, so are we given the PE ratio?
I think
yes, we are no.
We're only told that price earnings ratio of the company has been approximately constant in recent years. So we are indirectly, you are told to assume that this PE ratio will remain constant for any valuation you want to do. Okay, so can we get a current PE ratio?
Have any share?
Can we get the current PE ratio?
I think for the
issue,
we can use the market price divided by the EPS.
For 2007, right?
Yes.
Current PE ratio.
The share price of 2.5 divided by the earnings per share of 32.4.
Sorry, say that again. Current
share price
EPS.
of 2.5 divided by the earnings per share of 32.4.
Okay, so current earnings per share is what? 32.4. Okay, can we take that to dollar? That's 0.324. Do you agree?
Yes, yes. Please.
Okay,
yes.
So, and current P ratio would then be current share price, which is 2.5 here, divide that by current earnings per share. So, and that gives us current P ratio. Now we're going to assume this remain constant. Okay.
Please, sir, can you take that again? This current P ratio.
Current P ratio equals current share price 2.5 divide by current earnings per share, which is the earnings per share in 2007. Have you seen that?
Yes, sir.
Thank you, sir.
Okay.
Yes, I can see it.
Okay. So we've got this. Okay. Now this will be taken to remain constant for the purpose of valuation. Now, what are we expecting share price to be if we are using this PE ratio?
That would be P ratio multiplied by EPS.
So EPS, what EPS are we using?
So we calculate
What EPS are we using? That's the question. So what's your forecast EPS? Don't forget that they want to do an expansion. If they do expansion, they expect the EPS to change. Datico expect the EPS to change. Currently, EPS is 32.4 cents. So they want to invest $5 million. If Datico invests $5 million, it should have an impact on the EPS. So what do you think will be the forecast EPS?
We use dividend plus retention as earning divided by number of shares.
Interesting. Look at the last sentence in the first paragraph. The finance director of Datico expects that the expansion of existing business will allow the average growth rate of earnings per share over the last 4 years to be maintained into the foreseeable future. What's the implication of that sentence?
we have to calculate growth.
We have to calculate annual growth rate in earnings. So let's calculate annual growth rate in EPS. So what method are we using?
Historic average.
Okay, so historic average will be our initial or base earnings, EPS, is what? 0.277. Do you agree with me? Can we see it here? 0.277, 27.7 cents. So that's our base EPS. Okay? And the current EPS is this. So our growth in EPS will be equal to bracket open, current EPS divided by base EPS, bracket close, to the power of 1 over what? 4. Do we agree? 4, isn't it? Or result minus 1. So can we see it? This is the annual growth rate in EPS. So what is going to be our forecast EPS? Equals to what? Forecast EPS. Current EPS multiplied by 1 plus growth. Do you agree?
Yes, sir.
So this is the forecast EPS. So if we are now using P ratio to value the company's share, so what is the expected share price now? So that's equal to what?
P ratio.
P ratio times, isn't it?
EPS,
Forecast
yes.
EPS.
EPS.
So what do we have? 2.6 approximately, isn't it? It's just 3 marks. But you know, you need to think out of box here, isn't it? Any question?
Yeah, please, can you put the cursor on that forecast EPS, please?
Forecast EPS is just to grow your current EPS by the growth rate. Are you fine with that?
So the expected share price, P ratio times forecast EPS.
Exactly. After the expansion, we expect share price to be this.
Okay. Can I please see how you calculated the growth rate, please?
The growth rate, the current EPS divided by initial EPS, which is 2003 EPS, isn't it? And we took it to the power of the inverse of number of times EPS has changed. And then we subtracted 1 from the whole result. The usual growth rate formula, historic average. Okay.
That is, can you take it to expected share price?
Expected share price.
Yeah.
We multiply forecast EPS by the current P ratio.
Sorry, sir, can you maybe give an I think I'm confused with why we went with this route. Maybe, so, why is the expected share price current P ratio times forecast EPS?
Why is it so?
Yes.
Because we have to use P ratio method of valuation.
Oh, okay.
Yeah. So let's state it here. Using P ratio method. Okay, so let's move on. We are done with A, we are done with B. C part. Discuss whether the proposed business expansion is an acceptable use of the finance raised by the right issue and evaluate the expected effects on the wealth of the shareholders of Dacico. What comes to your mind here? Hello.
Maybe to see how the share price, what the total value is going to be using the share price, using the new share price, and to see how maybe how it relates to NPV. I don't know if that will work.
Another contribution.
I think it's just for us to compare the market value or before the rights issue and the market value using the new share price.
Okay, so it's important when you are assessing the impact of an investment or of such on the value of or the wealth of shareholders. What comes to your mind? Go back to section A of FM syllabus, where you dealt with financial management function. You remember we talked about total shareholders return. You remember total shareholders return? Can someone remind us?
Is it the formula or the meaning?
Yeah. What is the formula all about? Or what is it all about itself? Total shareholders return is a composition of two things.
Dividend plus capital appreciation.
Exactly. So now this company is investing $5 million to carry out business expansion. And from valuation, we can see that after this expansion, share price will become $2.6. Before the expansion, it was 2.5, isn't it? Hello?
Yes, sir. Yes, sir.
Okay. Now, this expansion requires them to go to existing shareholders to finance the proposal. And this is coming on a right offer basis. Now, once right offer comes into place, it then leads us to calculating theoretical extract price, isn't it?
Yes.
Okay, and that becomes the share price after the right offer. Okay. Now, the investors, they need to see the value this expansion is going to create. And using PE ratio method, we have seen that the value per share will be 2.6. Does that mean the shareholders will make a gain or a loss? That's the question you'll be asking yourself. So is it a gain or a loss?
It's a gain.
It's a gain because the theoretical extract price we calculated is 2.4. Is that not so? But
yes,
the new share price in the market after the expansion, 2.6. That means there's a capital gain of 20 cents. Is that not so?
Yes,
Hello?
sir.
So
Yes,
which
sir. Yes,
means
sir.
with this capital gain, it is true that using rights to finance the expansion will actually give shareholders the opportunity of growth in their wealth. Do we agree with that?
Yes, sir.
Okay. Now, on capital gain angle, we've sorted out that. Let's look at what happens on dividend. What do we think would happen to dividend? What do we expect to happen to dividend?
To increase, because
So
if the market price has
definitely they
increased,
will also be anticipating increase in dividend. Okay, so can we do that calculation? Can we do that calculation? What will be the next? What will be the next dividend they will be expecting? So capital gain, expected capital gain. So this is treating the C part. Equals to this value minus the theoretical extract price. And for dividend, expected dividend what? So that means if you look at current dividend is 15 cents. So what do we think will be the next dividend? How do we go about that?
You should find the growth first.
Okay, so we need growth in dividend. Which means what is the current dividend and what is the base dividend? Current dividend is what?
Current dividend 15 cents.
15 cents, 6.15. And base dividend is 0.128.
It's
So growth in dividend will be equals to bracket open, current dividend divided by base dividend, bracket close, to the power of 1/4, isn't it?
Yes, sir.
Minus 1.
Minus 1.
So this is the growth in dividend. So the expected dividend would then be 15 cents multiplying 1 plus growth. They're expecting this. If that is the case, then what then would be what would be the theoretic? I mean, what would be the total shareholders return that we are talking about? Before we can now comment whether, you know, there's a value in what they are proposing or not.
So that means we're going to use the share price before and after the expansion, right?
So
as
we already
the end of
we already got in capital gain. This is it now.
Oh, okay, okay, yes. Yes.
So total shareholders return equals to what?
Capital gain plus dividend.
Plus dividend, isn't it? The next dividend they are expecting. So divide by what?
Divided by share price at the beginning. The share price
so which share price is that?
Charitica X-Ray price.
Exactly. Thank you so much. Okay. TRP. So this is it. 14.83. 14.83% is the total shareholders return. So what will be your comment here to this C part? So we have assessed the impact on the wealth of the shareholders. So what will be the comment here?
The shareholders' wealth is increasing by 14.83%, and
is it increasing
it is 14.83%. Yeah, total shareholders' return is 14.83, while that TICO has a cost of equity of 10%. So it shows.
So you are saying we are going to compare with the cost of equity. Any reason for that?
Well, that's their, if they are shareholders, that means that they have equity. That's the expected return.
But if this is leading to a total shareholder return of 14.83, and this is greater than the cost of equity, then it makes a lot of sense to the investor. That's what it means. Okay. Impact. So we are writing impact of proposed investment on shareholders' wealth is better examined on the basis of what? Total shareholders' return. So total shareholders' return as calculated shows an improved return or an increase over and above the expected return to equity from 10% to what? 14.83%. This means the investment. So what they say we should do here, discuss whether the proposed business expansion is an acceptable use of the finance rate by right. So which means the investment is an acceptable use of the finance raised by the right issue. So before this, you can also state that capital gain, to explain to the examiner, capital gain is derived by comparing TRP with the expected share price after expansion. So, and Dividend. Is grown at anticipated constant rate as calculated. So this is what we are going to say, and it makes a lot of sense that, okay, the return that will be generated from this, you know, surpasses the cost of equity. So it means that investing by way of rights is an acceptable source. Any question?
Yes,
Hello? Sorry?
Yes, sir. I have a question. Please,
Go
can you scroll up?
Okay.
No, not to that point. The one before the explanation. Yes.
Okay.
Please, how did you get the expected the dividend?
The expected dividend. We grew the current dividend by the growth rate. Have you seen that?
Yes.
Okay. So.
Okay, sir.
Yeah, okay.
I have another one. So, how did you get the current and base?
So current is in the question. Look at it. Current is here, 15 cents. Base is here, 12.8 cents. Have you seen that?
Yes.
Okay.
Excuse me, sir.
Yes, please.
If you look at the question says discuss whether the proposed business expansion is an acceptable use of the finance raised by the rights issue and evaluate the expected effect on the wealth of the shareholders of that group. My question is, under examination condition, and I read this question C. How am I supposed to know? How am I supposed to know that I have to now compute, even though the question is not directly saying I should compute? How am I supposed to know that I have to think and compute some of these ratios you have, or these things you have computed, the expected capital gain, as well as the expected dividend, to determine the total shareholders' return? That this is what I need to be able to answer this question.
I like that. I like that. Okay. So to answer you, the question actually says you should compute. In a way, it says evaluate. Evaluate will require computation. Do you get that? So when you have to evaluate, there's an element of
Sorry, sir. Evaluate could also mean I'm reviewing whether the right issue is a good source of finance for them. What if I'm writing theoretical?
There's no way you will write. Evaluate is a combination of calculation and discussion. You will support your discussion with figures, because whenever you are evaluating, most times it comes with cost benefits in a way. What are we gaining? Let me put it that way. What are we gaining? That's how you can evaluate to say, this makes sense, justify it. So you must come with facts and figures. Do you understand? Whenever you're evaluating.
Yeah, I'm trying to understand.
That is the way it works for evaluation. You must come with facts and figures. So the fact is around the wealth. So what constitutes wealth? Remember when I started treating the question, I started by saying, go back to section A of FM syllabus. When you talk about shareholders' wealth, there are two things involved. And I call your attention to total shareholders' return, which is combination of capital gain and dividend. That's how you can truly measure wealth of shareholders, apart from MPV, in investment appraisal. Do you understand? So in percentage of return, total shareholders return, which it's a good one for you. So having known that you are going to work with total shareholders return, so you now need to think further. Capital gain, how can I compute it to support my argument? So you look for it. You know what you need to compare to get capital gain. You need the current price, you need the previous price. So you are talking about expecting a price of $2.6 after expansion. Then where are they coming from? They are coming from TERP of 2.4. So you compare both to get a capital gain. Is that not so? I need your response.
Yes.
Okay. Then you also look at, okay, we need to look for expected dividend after expansion. So today, dividend is 15 cents. So in the history, dividend has been changing, growing. At what rate? You ask yourself, can we apply that to it to know what they're expecting next time? So next time, they're expecting current dividend times 1 plus growth. So we did that to get the forecast dividend or expected dividend. So since we know the expected capital gain and we know the expected dividend, then we can calculate total shareholders return. And that's what led us to this 14.83. So you will now, somebody, had to think out of box immediately that for me now to evaluate and justify that, okay, this 14.83% is a good rate of return. So the person says, ordinarily, without investment, what are these investors expecting? They are expecting 10% as cost of equity, which is their return. So if this expansion is generating 14.83%, then it makes sense to the investors. And that's how you now conclude to say, that's part of your discussion to say, if they finance by rights, which leads to $2.4 as TRP, is going to eventually, generate a total shareholders return of 14.83%. That's it.
Thank you.
Welcome. So the next part of the question says, using the information provided, calculate the ex-div share price predicted by the dividend growth model and discuss briefly why this share price differs from the current market price of Gatiko. So let's quickly use dividend growth model to calculate the current ex-div, to calculate the ex-div share price that will be predicted by this model.
Sir, please, can you quickly place your cursor on the TSR?
Sorry, moment. Is it?
Like, I want to see. Okay.
Divided by the TRP.
Okay.
Listen out.
Yes, sir.
Okay. All right, so using dividend growth model, so we know the current dividend. We already have it up there. Okay, so we know the growth in dividend. We also have calculated that. Are we following? Hello?
Yes, sir.
So what else do we have? So we know the dividend. We also know the growth, okay, and we know the cost of what? The cost of equity. So can we apply it?
Yes. Okay.
Yes, sir.
So we know the current dividend, which we have also used growth to calculate the next dividend also. Okay. So maybe I should just restate them here. Next dividend, growth in dividend. So this next dividend is the forecast dividend or expected dividend after expansion. Growth in dividend, we also did that. So I can just go and pick those values. Next dividend is here, which is the expected here. Growth in dividend, we also calculated it. Is here. So the expected share price, ex-div share price, using dividend growth model, would then be equals to what? The next dividend, which is D1, divided by cost of equity, isn't it? Minus growth in, do we agree? Dividend, isn't it? Hello? Hello? Hello?
I don't agree.
Yes,
Okay, you don't agree. Oh, yeah,
I
tell us.
don't. I thought it's
Tell us
D1.
why.
I thought it's D1. Open a bracket, 1 plus growth.
Oh, that should be DO. If you are doing open a bracket 1 plus growth, that will be DO times 1 plus growth. And the whole of that will become D1. DO times 1 plus growth is equal to D1.
Okay.
So that's why we have done that as 15.6 now. Remember, we've done that now. Look at it here. We did it here.
Okay.
So I picked
So we should just use, okay, so in our case, we should just use 0.15, not 0.156. If we want to use the 1 plus growth.
Oh, if you want to use the growth, you have to use 0.15 so that you can apply your growth to it. Okay? That's why I labeled this as forecast dividend or expected dividend. It's not the current dividend. Okay? After expansion.
Please, can you just state the formula?
This represents my T1. Should I state what?
I said, can you just write out your formula?
Which formula is that?
The
one I apply here?
Yes. Okay.
What I've done here is equals to D1 divided by KE minus G. That's what I've done. Okay.
So why are you saying cost minus growth?
That's the usual formula now. D times, is that also 1 plus growth divided by KE plus growth? Is that not the formula?
Yes, sir.
Yeah, that's what we have applied now. So somebody is saying, why are we doing minus growth? So okay, tell us why you think we should not subtract growth.
Well, because what I thought we were going to do is using the dividend growth model formula and doing subject of the formula to now calculate the market price. And with that, I don't know where the minus G came from.
That's the formula. If you do that subject of formula, so look at it. Cost of equity formula using dividend growth model, isn't it? It's saying DO times 1 plus growth divided by PO, isn't it? Everything plus G. This is the formula.
Yes,
if you do subject of formula here now, you must get this. Did you get that? If you make PO the subject of the formula, it has to turn to this. Is that taking?
Yes, sir.
So I don't think we need this formula, but if you want me to retain them in the spreadsheet, I can help you retain them. I put them in italics. They are not part of what we need. So just for your information. Okay? About this PO. So do you now agree it's 2.62? Please confirm this figure. We have done, if you have used DO.
I got 2.60.
No, it's not possible. Using what? DO. Or using
yes.
What? Using so did you not apply growth to it?
I did. But I think it's the approximation I had done already because I used growth as 4%. Yes, I use calculator.
No. We are using 4.044% here. Approximately, it was 4.045. Okay. So this is constructive response question. It's not multiple choice where you would have approximated. Okay. So moving on, we have calculated and we've gotten the XDIV share price as predicted by DGM. But we are also asked to discuss briefly why this share price differs from the current market price of Datico. What's the current market price of Datico?
2.5.
Okay, so why the difference? Why the difference?
2.5.
Why is it now different from 2.5? Very cheap question. What do you think you asked to do there?
Very good market.
Sorry? Or what would be your response? Why do you think this price, differs from the current market price of Datico? If I were you ask yourself, how did we arrive at this 2.62? So that should tell us what will create the difference. Then this current market price of Datico, how did they arrive at it? Those are the questions you ask yourself. And that also will create the reason for the difference. Can someone tell us?
You were saying something before you said that's the reason for the change. Can you just repeat what you said?
So I'm saying to respond to this question that says you should discuss briefly why this share price you have calculated, okay? Why is it different from the current market price of Datico? So I'm asking that you need to now then ask yourself, how did you calculate 2.262? How did you get this 2.62? So that should explain the reason for the difference. At the same time, this current market price given to us in the question, how has it been established? That also should create the difference. So those are the things we are going to speak to. So I'm listening.
Okay, the
So
growth in dividend.
All right, what is the lady talking about? I'm listening now. It's a growth in dividend. What happened to it? Hello? Hello? Hello?
Yeah, we can't hear you. I can hear you.
So growth in dividend, what happened to it? Somebody mentioned that.
I think that the reason for the new share price of 2.62 is as a result of the growth in dividend which we have calculated. So that sort of gave what the expected dividend is going to be. And if dividend is expected to increase, I think that's why the value of the company through its market, its share price is also increasing. So that's what led to the increase in the share price to 2.6.
Okay, so you say DGM uses growth in dividend and assumes it is constant, isn't it?
Yes.
Yes, sir.
So that's the basis we have worked. Okay. Whereas, what will have happened? Whereas, in reality,
Also,
growth pattern will differ. Okay. But this could be the reason for the disparity, isn't it? What other reason can you point out? So DGM also assumes something. What is that? Hello? Hello, can you all hear me?
Yes,
Yes,
sir, we can hear you,
we
sir.
can hear you.
So DGM assumes something else. What is that?
It assumes that
Cost
dividend
of equity.
is paid.
So assumes constant cost of equity, isn't it? Is 10%, isn't it? But in reality, again, what will happen? Cost of equity may not be exactly this, isn't it? Great. So that's another point. So you've criticized DGM. What about this current share price? Can we criticize it? Hello?
yes, you can, sir.
So can we criticize this current share price? How has it been established? What determines the current market price? Nobody? Wow.
The
Or is it that you can't hear me? Sorry?
The share price is determined by the future dividend.
Future what?
Dividend.
No. The current share price of the company. How has it been established? What determined it? It's not a predicted share price. It's a current prevailing market price per share. What determines it?
Investors' perception.
So, which is what? Go back to capital market hypothesis. What is it talking about? Information. That's what determines the price. Is that not so?
Yeah, the information available.
Yes. So what can you say? Why would this price be 2.5? That's the current market price. And we have predicted 2.62. Okay. So why?
Yes.
What could have happened?
Because people
I'm listening. Hello.
the investors were not aware. They were not. The information given to them was not. They were not aware of the increase.
So it is possible that information in the market is probably not adequate, isn't it? So which can lead to inefficient market. Do you agree with me?
Yes, sir.
So let's talk about that. Current share price will be as a result of inadequate information about Datico in the market, leading to an inefficient capital market. So that's it. So this could also be the reason why that price is lower compared to what the model has predicted. So those are the germane points here to end at 6 marks. All right, so the E part has also been given to you. So this is just talking about this scenario to say you should explain the nature of the agency problem and discuss the use of share option schemes as a way of reducing agency problem in a stock market listed company such as Datico. So there's a scenario around this. Okay. So, and what is the scenario about? Let's look at what the scenario is all about. Okay, so look at the scenario. So it's saying at a recent board meeting of Datico, a non-executive director suggested that the company's remuneration committee should consider scrapping the company's current share option scheme, since executive directors could be rewarded by the scheme, even when they did not perform well. A second non-executive director disagreed, saying the problem was that even when directors acted in ways which decreased the agency problem, they might not be rewarded by the share option scheme if the stock market were in decline. These are two views from these two directors. So you are asked to explain the nature of agency problem. What leads to agency problem? And then discuss the use of share option schemes as a way of reducing the agency problem in a stock market listed company such as Datica. Hello?
Yes, sir.
Okay, so I gave a suggested approach here. So what you need to do is first to talk about what connects shareholders with the management of the organization. So you need to first talk about the principal agent relationship. So which means the managers are there to represent the interests of the agents, and the agents are the owners of the company. So they need to ensure that every investment they are undertaking is the type that will increase the value of the company, which will in turn maximize the share price in the market. So having said that, it then means that every manager needs to focus, on that objective. So like I said, investing in projects that will add value to the owner's wealth. However, we have seen instances where this will not happen. And what are those instances? It's been established that managers representing or supposedly to be in place to be representing the interest of shareholders will be found guilty of not, doing so. And they probably will be protecting their own selfish interest. So their interior motive will be what will be driving their decision. So it could also be that they will try as much as possible to hide information from the shareholders. And when they do that, what will happen? Shareholders begin to take decisions that will not, augur well their investments. So when they hide information, we call it information asymmetry. Okay, just like we are talking about inadequate information in the previous question, and it makes that market to be inefficient. Okay, going by efficient market hypothesis. Now, one of the ways Datica would actually address this problem is actually to offer these managers share option scheme. So what does that mean? It's saying that the managers will be entitled to buy the shares of the company at a future date at a price that will have been predetermined at the current time. So in the near future, they can buy the shares of the company at a price that will have been predetermined today, on the grounds that those share price will rise to a certain level. So they expect that the share price will rise to a certain level. That is the target. Okay, so if Datica decides to do this, okay, it's enticing. So the managers will be impressed, because what it means is that they would also want to do as much as possible to become owners of the business. Because once they own shares, they become owners. Okay, so it is believed that they should actually focus on projects that will maximize the shareholders' wealth. That is the belief. Okay, however, okay, it is very, very possible, on the other hand, that this may not be so. this may not be so. And those are the things that the two directors are trying to point out. Okay, so they will be doing all they need to do to ensure that they maximize the wealth. But if the company is actually operating, or this scheme is being offered during the time of financial crunch or market depression, what you see happening is that the share price will not rise. So if share price is not rising during this kind of period, you can't really say the shareholders are not doing their bits. Okay, so one director is saying that it is very possible that what is currently happening in the market condition, is not showing the performance of the managers. So one will now be thinking that they are not performing. That's what one director is saying. The other director is saying that it is even possible that they are doing all they need to do. I mean, they are not even doing all what they need to do, but the market is just doing well, and the market condition is improving, and the share price of the company is increasing. Whereas this company, I mean, the managers of this company are not actually doing what they need to do. Because where they are not doing what they need to do, it means there is agency problem. So there may be agency problem, but it's not showing because the market is perfect. The market is doing so well, and then the share price of that company is increasing, and it's not showing that the managers are the contributors to it. So you think that, okay, since the target is that they should maximize the share price, and the share price is actually increasing, that means the managers have met the targets. So that director is saying that you may be rewarding them for what they have not done. While the other director is saying that you may not be rewarding them for all the efforts they have done because the market is poor and share price is falling. So those are the arguments that have been put forward in the question, and that's how you are going to support the positions of the directors. Any question? Any question?
Just to clarify, it appears that our landing is that both directors are correct. Is that the position? I mean,
yes, so it appears that the two directors, there's no right or wrong argument there. So the two directors, they have their point. Okay, they are correct. So which means, look at the last paragraph there, is saying it is then very difficult to determine the share option exercise price and the date when this should happen. You can't really say because you are not too sure what will happen at that time. And at that time, whatever happens, you can't really say, okay, this is the effort of the managers, or the managers are doing what they need to do, but it's just the condition of the market that is not showing the performance. So when exactly can we say share option schemes should happen? We can't tell. And then how much should we say or set as the exercise price in terms of what should be the target share price? We can't really say. We are not too sure of what will happen in the market. That's what we are trying to say. So the two directors, they have valid arguments.
Okay, thanks. Got it.
You're welcome. So if there's no question, this is 6:40. Do we still want to run the last question, or we want to go and look at it ourselves?
Yes.
Well, since this is the last one and it's the last day, we should just push and just finish it.
We should just finish.
I don't know, my own opinion. No.
Okay. Do we support?
Supported.
Supported.
Okay, because we wouldn't know where the examiner is coming from. All right, so let's look at it quickly. Copperco is the question. So this is on investment appraiser using a joint probability table. Using a joint probability table. Now calculate the following. Calculate the mean or expected NPV of the proposed investment, 8 marks. Calculate the probability of the investment having a negative NPV, just a mark. Calculate the NPV of the most likely outcome, just a mark, and then comment on the financial acceptability of the proposed investment. Sorry? Hello? Now discuss two of the following methods of adjusting for risk and uncertainty in investment appraisal: simulation, adjusted payback, and risk-adjusted discount rate. Yes, let's quickly look at the A parts. I know for B part, we have them. I've given you the B part. So if you have any clarification, you can ask questions when we are done with A, so that we don't waste our time on the B. On A, let's look at how to address it. We have to calculate the expected or mean NPV of the proposed investment. Copperco is concerned about the risk associated with the proposed investment. And what is it doing? It's now looking for ways to incorporate risk into its investment appraisal process. So the company has held that probability analysis may be useful in this respect. So the following information relating to proposed investment has been prepared. So they have, for 2 years, they have their cash flows and they have the probabilities. Now, however, the company is not sure how to interpret the results of an investment appraisal based on probability analysis. The proposed investment will cost $3.5 million, payable in full at the start of the first year of operation. So Copperco uses a discount rate of 12% in investment appraisal. This is all we have been provided, for this scenario. Now, what do? We have to use probability analysis. So we have different scenarios in year one. Remember, probability analysis uses, incorporate risk into investment appraisal. And risk is about several possible outcomes that are likely to happen because we are likely to predict their occurrences. And we are able to do that based on past experiences. That is what risk is all about. And in this case, we are given several possible outcomes with their probabilities. That means we can reliably predict their likelihood of occurrences. In year one, the company is saying they are likely to have $1 million cash flow. It's just on 10% probability. 2 million cash flow, 50% probability. 3 million cash flow, 40% probability. Same thing in year two. They have those cash flow with their respective probabilities. The question is now saying, using a joint probability table, you should calculate the expected NPV of this project. How do we go about this? So what we need to do is to treat each of these scenarios separately. Look at year one. So 1 million cash flow on the probability of 0.1. That means we have also 2 million on the probability of 0.5, and then we also have 3 million on the probability of 0.4. Are we following?
Yes, sir.
Just one person I have left in the class or what?
No, sir, we are following.
We are following, sir.
Okay. Okay, good.
We are following,
Now,
we are following.
Good. In year two, 2 million on a probability of 30%, 3 million on a probability of 60%, and then 5 million on probability of 10%. Now, the thing is, if this cash flow happens in year 1, what is the present value of these cash flows? So we need to calculate their present value. Company uses 12% as what? Discount rate. So can we calculate present values? 1 million at 12% in year 1. What is the discount factor at 12% in year 1?
$0.893.
0.893. Which means we're going to use 0.893 for all of them and get their present values. So 1 million times this will give us this. So this is what happens in year 1. In year 2, what is the discount factor?
0.797.
0.797. Apply this to all of the cash flows, and then we get present values. So these are the present values. The examiner expressly asks us to use what? Joint probability table. When you ask to use joint probability table, it's different from you solving this directly to get the expected MPV. Okay, I'll show you the two cases so that you know. You need to pay attention to details. In this question, you have to use joint probability table. So this is how to use joint probability table. So we'll create the present value of cash flows in year 1 and also create their probabilities. In year 1. So we'll do same for year 2. Okay. Now, we will now look at different scenarios here. Look at it. Different scenarios. So scenario 1. Scenario 1 here is that if in year 1, the company has a present value of 893,000. Are you with me now? At a probability of 10%. Are we following?
Yes, sir.
There's likelihood that in year 2, the company will have a present value of this 1594 at a probability of 30%. That's scenario 1. Scenario 2 is that if the company is still having these as year 1 present value at this same probability, it is possible that in year 2, the present value will be the second one at a probability of 60%. Are we following? Are we following?
No.
So why? Where's the challenge?
That's from the probability. I don't understand the scenario distribution. From the first year, when you say if they have only 89.3.
Yeah, so we started by saying the present value of the first cash flow that they are putting forward is 893,000. Let's assume that is the first present value they got in year 1. is a probability of 10%. Is that not so? In year 2, you know, for that scenario, they may have a present value of 1594 at a probability of 30%. That's the first scenario. Second scenario is that why this is still maintained as what they're having in year 1. Situation may change in year 2 to become this value at a probability of 60%. Did you get it up to that now?
Yes, I do now.
Okay. The third scenario is that why this is still maintained in year 1 at the probability of this same 10%, situation may change that it will be this 3,985,000 at a probability of 10% here. So which means for each one, we would have three scenarios. Then which means the fourth scenario will be that the first year value is not this 893, but 1,786,000. And that also we have 3 scenarios. And that is at probability of what? 50%. Chances is that second year present value will be this 1,594,000 at probability of 30% that we recorded here. Fifth scenario is that why this is maintained in year 1 at this probability of 50%, it is possible that second year present value will be this 2,931,000 at probability of 60%. The sixth scenario is that why this is maintained in year 1 at probability of 50%, year 2 present value could be 3,985 at probability of 10%. So seventh scenario is that the first year value could then be these 2,679,000 at probability of what? 40%. And year 2 will now start with 1,594,000 at probability of 30%. The eighth scenario is that why this is maintained in year 1 at probability of 40%. Situation in year 2 could change to the second one of 2,931,000 at probability of 60%. And the last scenario is that why this is maintained in year 1 at 40%, the situation in year 2 could change to 3,985,000 at probability of 10%. These are the 9 scenarios that will happen. Are we following?
Yes, sir.
Yes, sir.
Okay. Now, joint probability will mean that we'll now need to total the values for each scenario. For each scenario, what do we think will be the total value? Total present value. So total present value will be equal to the present value in year 1 plus the present value in year 2. And then we'll do same for all other ones. Are we following?
Yes, sir.
Yes, sir.
Let me know if you are following or you are not.
Following for now.
Okay, following for now. Interesting. So the next.
Hello. I lost you a while ago, but my question is, if we have held each of year 1's present value constant and assumed the 3 scenarios of year 2, are you saying by these 9 scenarios we would have considered, we probably have held each of year 2's each of year 2 present value constant and then assume this several scenarios for year 1? Or why is it that it's only year 1 we are holding constant and then assuming changes for the PV of year 2?
We're also seeing this year 2 also repeating now. So it's about repetition. Do you get? So just think about it. You have different values in year 1, you have different values in year 2, and you are looking at what is likely to be the NPV of your project. You don't know what is likely to be. You need to calculate it. So you need to look at what plays out. What are the different scenarios that will play out? So the possibility here, that's why we're talking about possible several outcomes. First outcome, which is the first scenario here, is that it is likely that the first year value will be $893,000, while the second year value is $1.594 million. That's a first scenario that can happen. So we are saying that, let's say that this $809,000 is what happens in year 1 still. It may be that year 2 value is not 1,594, but 2,391,000. That's another possibility. So you are going to look at different possibilities, and that's why repetition is happening here. And you can see when year 1 changes to 1,786,000, year 2 also keep changing. Can you see? Same thing in the third case of year 1. Okay. Hello.
We're following.
Okay.
We're following, sir.
Okay. So these are the likely total present values that we will have. Different possible outcomes as well. But the thing is, we are asked to use what? Joint probability table. So the first scenario is going to be a joint probability of 10% in year 1 times 30% in year 2. So the first scenario is going to be a 3% situation on a joint probability basis. Are we following? We'll repeat all of those in other scenarios. So we have different joint probabilities, which means that we can then calculate the expected present value for each scenario. The expected present value of the first scenario is going to be what? Total present value times joint probabilities. Are we following?
Please come again.
Expected present value is going to be equal to the total present value of this scenario times the joint probabilities of this scenario. So we have this for the first scenario. And we will do that multiplication all through
joint probabilities, see multiplication of the 2 probabilities.
Yes, it's the multiplication.
Okay. Thank you. Sorry, my network is beginning to...
All your probability, the sum of all your probability must be equal to 1. Let's sum this. If you don't multiply, it will not be equal to 1. Look at it. I sum everything now. Can you see that is equal to 1 number? It has to be equal to 1 number. Can I see it? It has to be equal to 1 number. Okay. So now we have gotten the expected present value. Now for each scenario, what do you think we can get as expected net present value? So that means we should consider initial cost for each scenario. The initial cost is what? 3.5 million, isn't it? Remember, we are told 3.5 million naira. I'm sorry, $3.5 million. Can you see it here?
Yes, sir.
So, can you see it in the question?
Yes,
the proposed investment will cost $3.5 million. So if you charge initial cost to every expected present value, then we will get expected net present value for each scenario. So which is this sum with this.
Please come again. Okay.
How much do we have here? If 500,123, is that also? Okay. So we will then have to sum the two. If we sum the two, what do we have?
We'll have a negative.
Oh, I see. Okay, if you, this is it. Total present value is what I should be summing. What am I summing? This with this, we'll have what? A negative here, okay? So total value, total present value against the initial cost. This is the expected net present value, okay? Now, if you sum all the expected value here, what do we have? We have this, isn't it? $4,365,200,000. Then we'll now charge 3.5 to this total. If we charge that to it, what do we have? We'll get expected net present value for the entire project outcomes, okay? So this is the entire outcome. So this is a situation for the each scenario. Each scenario is saying total present value for the first scenario, charge 3.5 million, then we have expected net present value for this scenario. So we do for each of these scenarios, okay, because we're asked to do something here. Look at it. We are asked to calculate the probability of the investment having a negative NPV. So look at the different scenarios here and point out the probabilities where you record negative NPV. Okay, that responds to the Roman figure 2. For Roman figure 1, the expected NPV of the proposed investment is what we have done here. So we have the expected present value minus the initial cost of 3.5 million. We get the expected net present value.
The other column where we have expected net values, net present values, will you sum up to this 86,200?
No, it's not going to sum up. So it's the NPV. That's the NPV of each scenario. So which is what we're asked to calculate here. Calculate the probability of the investment having a negative NPV. So this is position of NPV without incorporating probabilities. You know that we didn't apply probability to this total value. We just sum the present values and we got total present values. And then what we did is to take out initial cost from it to get NPV for each scenario. So what we now did here is now to apply joint probability to the total present value to get expected present value. So it's at this point we get expected when we multiply probability. And then we sum all the expected present value and then take out initial cost to get expected net present value. So this expected net present value is the Roman figure 1 we are required to solve. So this is Roman figure 1.
If we don't do that last column, it's still okay?
Sorry?
That last column, are you saying that if we don't do it, it's still okay?
We do it because the question says we should get You know, I was telling you about several possible outcomes. It throws out different values from which we can tell what is the likelihood of having a negative value on this project, or what is the likelihood of having a positive value on this project. That is the essence of this joint probability table. It's throwing out different values. So each scenario has its own value. Okay, so the question is saying now here says, calculate the probability of the investment having a negative NPV. One of the uses of probability analysis is to help detect the probability that the company can have a negative NPV on a project. So look at it now. Check for me those values that are negative. Can you see them? Can you see those values?
Yes,
These are
sir.
the values. So what is the likelihood of recording a negative NPV? That is what we are asked to solve in Roman figure 2. So what are we going to do? We will sum up those probabilities. Can you see it? For this first one is 3%. The second one is 6%. And the third one is 15%. Those are the probabilities. So we sum them together and it shows 24%, which is the probability of having a negative NPV on this project.
Okay.
Okay. So the next question says what? Calculate the NPV of the most likely outcome. What is the most likely outcome here? The NPV of the most likely outcome.
6, 7.
So most likely outcome. See the outcome here, 677. So the NPV this person talk about. So the probability of the most likely outcome. Here you have 3%, 6%, 1%, 15%, 30%, 5%, 12%, 24%, 4%. So the most likely outcome is that outcome that has the highest probability. You know, likeliness or likelihood of occurrence is in probability. So likelihood of occurrences is saying this particular scenario is going to produce 30% chances, okay, which is the most likely occurrence, 30%. And the NPV is what? 677,000. That's Roman figure 3. At the highest joint probabilities. The fourth question is what? Comment on the financial acceptability of the proposed investment. What's our comment? What will be your comment?
Except because the NPV is positive.
I think it should be accepted since the expected present value is positive.
Okay, so it should be accepted.
And there's a very low probability of it having a negative NPV.
Oh, really? Interesting. So it should be accepted on that basis.
Can you go over this NPV of the most likely outcome again?
Sorry?
This NPV of the most likely outcome, can you go over it again?
Okay. So this is saying NPV of the most likely outcome is at the highest. So that's our definition, that it is at the highest joint probability. Hello, can you still hear me?
Yes, I can hear you.
Oh, okay. So NPV of the most likely outcome is that outcome that occur at the highest joint probability. So let's look for joint probability. Which of these is the highest? So you need to scan through which is the highest. We can see that this 30%. If you take it to percentage, this is 30%. The fifth scenario here is showing 30%. Okay, so which means the most likely outcome is this 677,000.
Okay, thank you.
So in terms of if the company wants to know the likely value of this project, they will say it's likely to be 677,000. That's what they are trying to say. Most likely. Okay, that's what they are trying to say. Now, what will be our comment? So someone says we should say Copperco should do what? Accept the project.
Yeah, the NPV is positive.
Okay.
Even the
expected NPV is positive and will add value to the investors' what, isn't it? That's what you are saying, isn't it? Okay, yes. That's a valid point. Is there any but there? So you now said 24% is a lower probability. Is that what you are saying? You would see 24% as a lower probability. If a company is running a risk of 24% probability of having a negative NPV, is that not significant? However, you cannot judge that is significant. Is that not so? So you as an advisor would have to tell the company that it boils down to what they can shoulder as risk. Is that not so? Because the risk appetite of company varies. A company could see 24% of probability of having a negative NPV as insignificant. Another company may see it as so significant. So we have to hang it on the risk appetite of that company. That's the only way you can convince the examiner with your comment to show that you actually, proving your worth. So we'll say it is, however, important that Copperco considers its risk appetite as it has been estimated that chances of having a negative NPV is about 24%, which may be significant for an entity. Shoulder risk. That's what you will say. Okay? It makes sense that way. it makes sense that way. Any question? Hello, any question?
No question, sir.
Okay, so if there's no question, I think we are good with that. So it's just the B part. If you have any clarification for B part, I've sent it to you guys. So if you have any clarification, if you have read through and you have clarification, let me know so that I won't take time of. I won't take your time again. So because this is already 17.
Some of us are not on the group, so we cannot see what you sent.
Interesting. Okay, so you want me to run through it again? Okay, so no problem. What this question is saying is that you discuss two of the following methods of adjusting for risk and uncertainty in investment appraisal. So examiner has given three methods here. He says you should pick any two of these and then discuss. So the three have been discussed here, depending on which one you prefer to choose. But we have provided the explanation on the three. The first one is about simulation. What we have done now on joint probability table, it's about simulation. And what simulation is saying here is that there will be different probability distributions and you have different variables. So different probability will be attached to different variables and there will be several possible outcomes. So you want to see how it play out using probability analysis, because this is going to use probability analysis as well. So this scenario of joint probability table we have demonstrated is a case of simulation. So you are allowing for different possible outcomes to come up. So they will come up randomly. Okay, and then you will have different values showing up. Unlike what happens in sensitivity analysis. Sensitivity analysis is about uncertainty. Okay, so because it is holding all other variable constants, only one variable is changing. But in this case of simulation, all variables will be changing. All variables will be changing to have different kinds of scenarios. And that's why you see when we say the value is this, it could be this next time. It could be this next time again, and all of those things. And we are seeing those. So all of those have been demonstrated. That's a case of simulation. So it uses probability analysis and it helps to test to get results as to what is likely to be the expected NPV. So also it can give us, estimate as to what is likely to be the probability of obtaining a negative NPV, or like we did now, the NPV of the most likely outcome. It can also be used to test the standard deviation of the expected returns. So all of these things are things that play out with simulation and probability analysis. So, like I said, simulation also incorporates probability analysis into the way it works. Now, adjusted payback. Recall how we treated payback. Payback is just like, okay, how much is invested? How much cash flows are we expecting? And then let's see how these cash flows are settling these costs. And then up to what point did we pay up the cost? And that is payback. But adjusted payback, and recall that in that case, it does not consider time value of money. It does not consider risk. But adjusted payback is like you are trying to shorten the period. You are trying to, because of the uncertainty associated with your future cash flow, you are trying to make sure the cash flows are brought nearer to the present time. So, which means you will discount those values Make them smaller, considering the time value of money, considering the risk. And then by the time you do that, what will happen? You have smaller values that plays out as cash flows. And then by the time you use those ones to pay down the cost, you find out that it takes a longer period to pay down the cost. It elongates the period. And that gives a clearer picture or reality. It speaks to reality. And that helps investors to make optimal decisions on their projects. You will be deceived if you are using just payback, because you see it paying back in a very short time, and you think that it makes sense because it is within the acceptable or tolerable period you have set as your target. But if you have used adjusted payback, the period will be elongated, and it will show clearly that it's not paying back within your set target. So either you are going to review the set target, or you are going to jettison that project on that basis. So the other method here is about risk-adjusted discount rates. Okay, so you agree with me that discount rate is what you use to, discount your cash flows and then get value of the project. So on what ground will that discount rate be adjusted? So it's only when the risk of the business or the financial risk of the company is changing. And that's what will lead to risk-adjusted discount rate. The same way we have computed project-specific discount rate is what we are talking about here. So using CAPM formula. So when there is a change in risk of a company, either from the business or from the financial, there is need to have a risk-adjusted discount rate. And it will run through the process of ungearing and regearing to arrive at project-specific cost of capital. So that's what risk-adjusted discount rate is talking about. And if you have gone through that, it means you have incorporated or you have adjusted for risk in investment. Any question? Any question?
Not from
Any question? End. Sorry?
So not from my end.
Okay. What about others? So, Camilla,
nothing from my end too.
Okay, Erika, you're fine. Martina, you're fine.
Good.
Sorry?
I'm good to go.
You're also good. That's fine. Ebuka, good. Okay.
How the probability table is marked. So if you don't complete the full table.
Sorry, I didn't get that.
I'm asking, how is the probability table marked? For example, if you don't get to the final answer of your expected net present value, will there still be some marks for the other small calculations?
Okay, so in this case, if you're able to, let's go back to that question. So if you're able to demonstrate this table, if I hear you well, you are not able to calculate this expected net present value. Is that what you are saying?
Yes, sir.
Okay, so that's fine. Remember, calculating this is 8 marks. So the 8 marks is not going to be awarded to you on just this final answer. So the 8 marks will be awarded to you on this demonstration you have done. Each expected value you have calculated here, you will be rewarded for it. Did you get that?
Yes, sir.
Each of those expected present value you have calculated, you will be rewarded for it. That's what I'm trying to say.
Okay, sir. Thanks.
Okay. So there's something I mentioned the other time. I don't know. I mentioned something about, maybe I should demonstrate something. Let me demonstrate something here so that you can see how this works. So look at something here. So you can calculate expected net present value for each scenario as well. So this is what you are going to do. So the joint probabilities here will multiply by the MPV. So we'll get expected net present value for each scenario. And guess what? If you sum all of these, it will give you the same value you got in here. Can you see it? Hello, can you see this?
Yes, sir. Yes, sir.
So which means you can also be asked to calculate the probability of the investment having maybe a positive or a negative expected net present value, not just MPV, but expected net present value. So which means at this point of MPV for each scenario, we will now apply joint probabilities to it, and they will give us expected net present value, okay, which is still going to be the same response because they are just these three scenarios, which is 24%. But you could be asked different questions. This can also come in a multiple choice question where you are asked to calculate, the expected net present value that will most likely happen. So take, for instance, in this case, the expected net present value that will most likely happen is 203,100. Because that is what is happening at 30% here. So I just thought of also showing you this. I'm going to keep it in the solution so that you see it. Okay, so in the usual way without using joint probabilities, what would you have done in this case? In the usual way. So in year one, what you will have done is to calculate the expected present value by doing what? Multiplying present value by the probabilities, isn't it? And you will do this. So you do same for year what? For year two. Probabilities multiplying the present value, and you get the expected present values. And what do you do eventually? You sum the present value in year one, and you sum the present value in year two. And then you say that the net present value is what? You say the net present value is what? Expected net present value. You say is equal to the sum of the expected present value minus the initial investment. Is that also? Hello?
Yes, yes.
That's what you would do, isn't it?
Yes.
Let me state
yes.
The initial investment somewhere here. Initial investment or cost. Negative 3.5. So you say this present value in year one, expected present value in year one, plus expected present value in year two, then you net it against the initial cost. And you say this is it. Is it not the same value we got? Can you see it?
It is. So why are they asking us to go this route?
Yes, the examiner purposely asks you to use joint probability table. If you have done it this way, I just did it, you will not earn the mark. That's what I'm trying to let you know now. This is the usual way you will have done it without using joint probabilities. Okay? And it looks straightforward, isn't it? Okay? But
yes,
the examiner compels you in this question to use joint probabilities, which is extending you to simulation approach. He wants to see the different possible outcomes that will happen with different scenarios. So please take note of this. Very important. So that you'll be able to distinguish the solution. So I'm going to put this without using joints, without using joint probability table. But using joint probability table is this. So using joint probability table. Okay. So please take notes.
Sir, but me, I even thought we're just going to multiply the cash flow in year one by the probability, sum it up, then get one figure. No, so we'll do cash flow. We'll do 1 million times 0.1.
If you do that, then, it is this. That means it is without joint probability you are solving it.
Oh,
if you do that, so you multiply this by this.
Yes.
Multiply this by this, sum them together, then discount at 0.893. You will get this 5390.
Oh, okay.
That's what you will get. It's the same thing.
Okay.
But that's not the approach the examiner wants you to use. This is just strictly probability analysis. But the examiner say go to the extent of joint probability table, which is simulation. Simulate out all the possible scenarios. And that is this table. It's deliberate. Okay. So thanks for waiting to this time. I wish you guys the best. I'll be happy to hear from you guys. Successful completion of this paper with 4-letter word PASS by God's grace.
Amen.
Thank you. Amen. Please send this Excel.
Definitely, I'm sending it.
Thank you very much.
And can we also ask questions on the platform if we're stuck?
Definitely, please. This is the time to ask questions. Ask questions, please.
No, I mean on the WhatsApp platform.
Yes, on the WhatsApp group, please. This is the time to start.
Thank you very much.
This is question time.
All right, thank you.
You're welcome.